Your piece out this morning. It's a little bit technical, but I want you to run through things. When the Bank of England comes out with a rate decision, bank rate means a lot for a lot of people in the UK, for business loans, for mortgages. The Fed funds rate is a different beast, and you're pushing back against the continued use of targeting the Fed funds rate and using it almost, Bill. Can you just walk me through the thinking here?
Well, the federal funds rate used to be important because reserves in the banking system were quite scarce, and so banks had to trade the federal funds rate, federal funds between themselves to satisfy the reserve requirements. That's not the situation today. The banking system's awash in reserves as the Federal Reserve continues to buy 120 billion of treasuries and agency mortgage-backed securities. So the federal funds market's become very different, very much smaller and much more idiosyncratic than it has been in the past. The motivation for this piece was the fact that the Fed last week had to make a technical adjustment to two short-term interest rates, the rate they pay on overnight reverse repurchase agreements and the interest rate they pay on reserves, 5 basis points each. Why? To supposedly keep the federal funds rate closer to the middle of its target range. Why are we targeting the federal funds rate in the first place at this point? It's no longer an important market. The Fed has the ability just to pay the interest on reserves. Why not ditch the federal funds rate target and just set the interest rate on reserves at the level that's appropriate with the monetary conditions that the Fed seeks to accomplish?
Well, that's your simple solution. In your words, 3 words, drop the target. Bill, could you anticipate a communication issue around doing that if they were to do that this year?
I think they could explain it very easily. They would no longer have to make these technical adjustments that I think are more confusing than illuminating. Also, another thing that they need to do is exempt reserves from the leverage ratio. As they add more reserves to the banking system, that's putting downward pressure on rates. The whole reason why they had to make this technical adjustment to the federal fund, to these two interest rates, push the federal funds rate up, was the fact that they're flooding the banking system with reserves. Banks don't want the reserves because of the leverage ratio, which is starting to bind as a capital requirement for banks.
And
So
Bill,
if you exempt reserves from the leverage ratio, then that problem goes away as well.
And Bill, you're talking about the glut of deposits that you're seeing on some of the bank books, with some banks even saying to their corporate clients, we don't even want your money because it is getting to be excessive. Just taking a step back, how much is the change that you're proposing evidence that we're going to remain in this environment with a system awash in cash and the Federal Reserve pumping money continually into it, even though there is so much cash? How much is it just sort of an acknowledgement of that reality over the near and, frankly, not even that near term?
Well, I think that we're going to be in a system where there's lots of reserves in the banking system for some time to come. First of all, the Fed's not going to stop their asset purchases quickly. It's probably going to continue well into the fall. So the balance sheet's going to continue to grow. The amount of reserves in the banking system are going to continue to grow. And then when it finally decides to start to normalize its balance sheet, the balance sheet is so big now, it's going to take a long time to get it back to, the $1.5 trillion of excess reserves that we had prior to the pandemic. So I think we have a system where the interest rate the Fed pays on reserves is the primary tool of monetary policy. Let's acknowledge that.
I understand, Bill, the argument that the Fed wants to continue with their very easy money policies, just simply to allow inflation to pick up and allow employment to get to a better place. However, people have pointed to certain frothier areas, in the mortgage market in particular. Do you think it's advisable? Do you think that it would harm the progress that the Fed is allowing to happen in the economy for them to pare back on some of the mortgage debt purchases that they make every month?
I think it would have an effect more on expectations about future monetary policy. It would tell the market the Fed has now acknowledged that they've made substantial further progress towards their goals. And so people would change their expectations of the timing of tightening. So I don't think it would be that important in the narrowness of the housing market. I think it would be quite important as a signal of monetary policy and the timing of tightening of monetary policy.
Is that the preferred method versus...
So I don't think they're going to do it. I don't think they're going to do it. I think they're going to be pretty patient here.
What about perhaps maybe more of an equal weighting taper? I think a la December 2013 and a discussion of $5 billion in treasuries, $5 billion in MBS. Is that just more of an easy path to go?
Well, I think that you have a template from the last cycle. And so to deviate from that template, you have to have a really good reason. I don't think they have a really good reason. I think if they deviate from what they did last time, just raises a bunch of questions. What are you concerned about? Why aren't you following the game plan that you followed last time?
What did we learn from last time around, Bill? The lessons of the last time we reduced asset purchases and eventually actually had some balance sheet reduction several years later.
Well, I think it went, in all fairness, quite smoothly once the Fed communicated clearly about what the sequence was going to be. First, we stop the asset purchases. We taper the asset purchases down. Then we raise short-term rates, and then we finally start to normalize the size of the balance sheet. So this time, the market has a template to look at. Last time they didn't, and so there was a lot more uncertainty about what the Fed was going to do in the last cycle compared to this cycle. I think it's one reason why the markets are pretty comfortable with what the Fed's up to.
Do you think that there's too much Fed speak at this point? We've been talking about how there's very little dissent, and there basically is a Fed official every hour who's speaking.
Well, there's always probably too much Fed speak. I mean, the thing to pay attention to is really the chairman, the vice chairman of the Board of Governors, and the vice chairman of the Federal Open Market Committee. So Powell, Clarida, and Williams.
Bill,
what
forgive
they
me for
say
jumping
really,
in. Are you saying ignore the Fed presidents when they go around doing speeches?
Yes.
I wouldn't say ignore the Fed presidents, but put a lot less weight on them because they're just one member of the committee. I mean, the big three set the agenda for the Federal Market Committee. The committee's not going to do something if those three people aren't on board. So it's about weight. Don't ignore the presidents, but don't put too much weight on what one individual president might say.
Bill, just how much they influence the conversation inside the Federal Reserve when you have those FOMC meetings, when you had the likes of Plosser, Fisher really pushing back at the turn of the last crisis, going through the recovery. Just how much do they influence the conversation?
I think they influence the conversation because they offer a different perspective, and I think diversity of views is actually important. Diversity of backgrounds is actually important in terms of getting good monetary policy making. But at the end of the day, the committee is going to go where the consensus is. So if someone's always dissenting, they sort of marginalize themselves because they're not relevant in terms of figuring out where's the committee going to go in the future. Right now, there's a lot of disagreement about when should we start to taper asset purchases because people are uncertain about the state of the recovery and how fast will it cut into unused labor resources. There's quite a bit of disagreement right now about timing. But the people that matter are Williams, Clarida, and of course Powell, because they're the ones who are going to determine the ultimate timing.